Is the DC market about to collapse, or has it done it already? We're going to break it down a little bit for you today. Hi, welcome back to another Coffee with Coleman. We love to discuss Washington, D.C., business, real estate, all that good stuff. My name is John Coleman. I'm a real estate agent here in Washington, D.C. with the Jason Martin Group. What we're going to do today is we're going to sprinkle you with a little bit of data, a little bit of knowledge, and things that you need to be thinking about as we go through this next 6 months to see where this year is actually going to end up. So let's set the table for how we got here today. Like last year, I was standing or sitting, or I was in this office talking about how crazy this market is. In fact, I released a video that was completely about how to compete in the seller's market, talking about love letters, waiving inspections and contingencies, and it felt like there was no end in sight. And then we started hearing the little thing called inflation. What happened with inflation is the Fed started saying prices were going up too fast, and they needed to combat that because if it got out of control, it could mean economic disaster for not only the United States, but for the entire global economy. So here we were, fat and happy with 3% interest rates. Like, what's gonna happen? We got to 5% by June. And then we started to realize that it wasn't gonna stop. In fact, between June and November, it went up another 50%. By November, my purchasers were looking at interest rates of 7.5%, throwing their budgets completely out of whack. And what this ended up doing is it ended up
slowing down everything.
Because you have first-time home buyers that could no longer afford what they wanted. And then you had people that were in houses locked into 2% interest rates that didn't want to move anywhere because they had it so good. So not only did they have to buy a more expensive house, but the increase in the interest rate just made everything so unattainable for them to move forward. But the reality is people wanted to buy homes. People didn't stop calling me, they were just discouraged by the numbers. So it was gonna be really interesting to see where things ended up. And the stats for last year were fascinating to follow as well. Last year at this time, we were talking about what might happen in the market. Most people predicted between 1 to 5% increase in prices. And we were laughing at them in June. Because in June, we were already up 9% year over year. We weren't laughing for too long. Because by the time we got to Christmas, well, that increase of 9% actually dropped to only 1%. So while we ended up year over year 1% in the median sales price, we actually went down 8% from June till the end of the year, which is what we were really seeing, feeling in the market. The reality of that is there was 35% less homes and 32% less transactions happening. So there's no transactions really to be had. There was no homes to put people into. So everyone just kind of chilled out. And the number one thing I heard from people in the fall was like, hey, let's just wait for this market to crash. Once it crashes, I'll buy, I'll get a good deal. The problem is I don't think the crash looked like what everybody expected it to be. It's not 07, 08, 09. It's not the bottom falling out. We had a momentary pullback of prices in the market. At the same time, people weren't able to take quite advantage of it because they didn't want to be shopping in a volatile market with high interest rates. Now fast forward to today. Interest rates, they're not as high as they were. They're definitely not as low as they were at one point. But we're dealing with something that DC has frankly dealt with for a long time now. And I don't think this is a changing topic. We don't have inventory. There's not enough houses. People that do have houses and they move to new ones have an option of renting them out. I myself rent out my other house because financially it just made too much sense to hold on to it because with the low interest rate, the rent I get from my tenants helps cover the mortgage plus a little bit, and financially, that's a really good spot to be in. And so now you fast forward to today. Where are we in comparison to last year? Last year, we were at the apex of home prices. If you go through an entire market with these high interest rates, and you're like, man, where are we comparison to the highest time we've ever seen in real estate prices in US history? We're 1% behind. That's it. We are down 1% year over year from one of the hottest markets we've ever seen. So as you look at the data and you look at the news over the next little bit, there's 3 things I want you to keep in mind. Number 1, don't look at year over year data for the next little bit. It's not gonna make sense. I don't think that our pacing is going to keep up with how fast and how high it went. And that's going to make it seem like year over year prices are down. And that's what will be reported until we hit about June. Once we hit June, that's when the interest rates started going up last year. I don't think the interest rates are going to go up like it did last year. And so I think that we are going to have a cross section of where the prices this year could actually end up being higher than last year despite all of the stuff that we've been through recently. The other thing you need to pay attention to is interest rates. If they do go up, it's going to impact us. There's no way about it. We've already seen a point this year where interest rates got into 5s for like one hot second. And in that one hot second, people looking to buy homes started surfacing really quick. So the general consensus is if we get back down into the 5s, this market is going to start moving quickly again. And in some areas, it's already moving too fast. The third thing you're going to want to look at, and we can set you up on a search and help you kind of monitor this, inventory. It's just really not going to be around, and it's not going to be totally available. Inventory is going to continue to be at a spot that is slim pickings. And so you're going to have to find different ways to get tactful in how you find properties, whether it's on market, off market. And the reality is in some areas you're already having to compete, and you should go back and watch my video from last year because that one breaks down exactly what you need to be doing. So those are my 3 main things. There's 2 subtext items that I want. First is DC. And is DC becoming cool again? Are people moving back to the city? Traffic and tourism, restaurants opening, and businesses starting to have people come back in the office is telling me that there could be a shift of convenience of coming back into the city. I don't think that that's a 1-month thing. I don't even think that's a 1-year thing. Over the next 3 to 5 years, being in the city could start becoming popular again. And during the last little bit, it's been very popular to be in kind of the suburbs, but traffic wears on everyone, trust me. The second thing is this data is very high level. Our market is so area specific that if you want to know this data for your own specific area, drop me a note and I'm happy to tell you what we're seeing in your neighborhood. Some of them aren't moving quite as fast and some of them are crazy fast. And if you're going to be shopping or if you're going to be looking to sell in the next little bit, it's really important for you to know what your market is currently doing so you can set your expectations accordingly. All right, so that's what I had for today. Good news, bad news, in between, we had it all there. The important thing is you keep up to date with everything that's going on in the market, and that's what we're here to do. So if you have any questions, go ahead and drop me a note. Otherwise, I just want to thank you for stopping by another Coffee with Coleman. Peace.